Joining us now for Fund Focus, Ivan Missankov joining us. He's a fund manager at M1 Capital. Appreciate your time, Ivan. Looking at your equity fund, it's a South African focused equity fund. It has won a couple of awards in terms of the best newcomer into the Africa category. What strategy are you embarking on right now? What exposure do you have? And let's perhaps start with the resources side of things, because I know a heavy holding in Anglo-American, full allocation at around about 10%.
Yeah. Bronwyn, our maximum positions in the fund that we take are 10%, and the maximum position currently is Anglo-American. Our overall resources exposure is sitting at 40%, which is, some would say that is pretty aggressive. We work on a very quantitative model, and we're very value-driven, we're very return-driven, so if we see value in a certain sector, we tend to go for it because we try to make money for our clients. So Anglo-American is one of those interesting ones, and we're very well aware that certainly the situation in Europe impacts the resources prices. It does lead to a lot of volatility. Mining stocks tend to be the most volatile shares in the market historically, and they continue to do so. So day in, day out, if the news is good in Europe, for example, coming out of Europe, there's suspicion that there might be some sort of agreement, resources prices shoot up, and once the pessimism sets in, then resources prices shoot down in the opposite direction.
So it goes back to the volatility that we were talking about earlier.
Absolutely. So we focus on long-term returns, and we sacrifice short-term volatility for that, simply because our view is that we cannot manage that, and certainly other people can't manage that. And if we superimpose a volatility requirement on shares, right now in the current environment, you'd probably not have much to invest in. But on a look-through basis, we find a lot of value in resources. Anglo-American in particular, the point I like to make to people, in the last 29 years, if you look at the P/E ratio, the price-to-earnings ratio of Anglo-American, it's been below 10 on 6 occasions. I think now is the 7th. On those 6 occasions, and going back, I think the first time was maybe 1983, 1984. If you look at the price return on Anglo-American, in the 18 months after the P/E ratio hit below 10 level, on 4 of these occasions, the return on Anglo-American was over 100%, 130%. On 2 of them, it was plus 30%. So that is only a quarter of the reason for the decision we've taken, but it does give us the strength to stay with the position.
And Mohammed, there's a big case being made for Anglo-American at the moment, specifically when you're looking at choosing between the two diversifieds, because Anglo-American has underperformed BHP Billiton to this point.
I think, Bronwyn, the case is certainly strong. If you look at Anglo's, you look on an earnings multiple basis, again, looking very, very attractive relative to some of the other resource counters out there. It's a well-diversified miner as well. Something that I want to maybe just pick your brain on here is if you're looking at a lot of your base metals, you're looking at a lot of your commodities, the stresses in China starting to show, and I know you just mentioned earlier that you were traveling to some of the emerging markets. If that pans out, obviously that'd be quite bearish for commodities and by proxy for stocks like Anglo's and for Billitons. But what is the sense that you're getting on the ground of a lot of these emerging markets that you've been visiting?
There's a lot in that question, a lot to say, so I'll try and keep it as brief as possible.
We'll give you some time.
A quick broad answer to that is if you think there are bad times in Europe and in the US, there is no such thing in South America, and there is no such thing in Asia, particularly in China, even in India. India, through the recession, maintained a plus 5% growth rate. There are investment managers who will show you companies growing at 40, 50, 60% through the recession, 2008, 2009. China, if you meet the investment people there, if you talk to companies there, you will be no doubt that that is where the future of the world lies, without a doubt. There may be short-term retracements, there may be short-term declines.
What about the unknown factor, like the municipal debt issue and the stuff that we don't know about China?
I think the stuff that you don't know about China is I don't think there'll be too many surprises. I think they manage things pretty well. The government is pretty controlling. It's not the traditional version of a Western government at all. But at the same time, it leads to a lot of efficiency. It's a 5,000-year-old civilization. They really know what they're doing. If you look at places like Singapore, Hong Kong, Taiwan, Macau, these are all places where Chinese people have been free to go about their business. Now you're talking about a billion-plus country where Chinese people are being allowed gradually to go about their business. You can imagine what will happen there. Having said that, there's always a risk. There have been 3 property busts in China to date in the last 15 years. There might be a 4th. Okay, and that for sure is a risk.
But will that cause a meltdown?
I certainly don't see the growth rate dropping anything significant from 10%. It might go down to 8%. As I mentioned, I gave India as an example. Through the recession, it was 5%. Things were as bad as they could have been. Every single country in the world was affected. The growth rates were very significant. A quick mention of Brazil. Brazil today reported a drop in their growth rate, for which they blame Europe. I can tell you on the ground, let's take private equity funds as just a good indicator of the kind of money that's flowing. In South Africa, we don't have $1 billion private equity fund. In Brazil, there are $9 billion plus private equity funds operating, and these are Brazilian funds, excluding international money that's being in that's invested in there. So you do have listed money as well. Incidentally, interest rates are in the order of 20% in Brazil, so it attracts a lot of capital, which has led to the measures to prevent the strengthening of the currency. So these are very high growth areas and certainly quite disconnected once you're there talking to the people from what we're seeing in Europe especially.
We're getting fabulous insights and analysis this evening. Something else I want to pick up on, and it's a theme I've been pushing on the desk, is Sasol. I see that you have no exposure to Sasol. My argument to people recently has been, why would you want exposure to Sasol given the external factors that impact the stock that are beyond your control? The two biggest ones, obviously the rand and the oil price. Why don't you have exposure?
There's one reason, and one reason alone, why we always have exposure, why we don't have exposure. In every single decision that we take, we don't predict, we draw a conservative scenario, and then we compare the current price to that conservative scenario. So, any one particular deal, that's exactly how we manage the fund. So if the price is too high, if it's not going to give us an acceptable return on a conservative scenario, we won't buy the share. That's been the case for the last 2 years since we've been managing this fund. So we've never held Sasol.
I mean, something that I want, given your kind of ideology and your methodology that you apply, and given the volatility we've seen in the market over the last year, we've seen massive swings in a lot of those counters, Sasol, Bulletin, whatever it may be. What does that mean in terms of your fund specifically, in terms of churn? So how often do you actually churn the portfolio? You'll be getting in, getting out. If you apply this disciplined approach, how has that impacted your fund from a cost perspective and from a returns perspective?
We are indeed very disciplined, as you say. That is in fact the case, to the extent that it gets pretty boring as well. Again, it depends on the price movement. So we monitor prices on a monthly basis, on a continuous, but we act on a monthly basis. We typically rebalance on a 3-monthly basis. So if the share price has gone up enough to give you your expected rate of return and we find a better opportunity, we'll sell out of it. Again, something I should stress in this sort of approach, again, we don't predict. We derive a set of conservative assumptions. So that by no means does that say that you will get your return or that things wouldn't be better. Things will be better. We're quite happy to miss out on good times as long as we don't get surprised by bad times, which is why we use a conservative approach. In terms of actual churn, we typically rebalance every 3 months. And on average, we've rebalanced, historically on average, every quarter we rebalanced about 10 to 15% of the fund.
We've spoken extensively about resources. We've got just a couple of minutes left. Other exposure that you have, or other exposures?
Your earlier guests were talking a lot about life insurance, very knowledgeably, in a very insightful manner. For what it's worth, Liberty we entered about 6 months ago at about 73 Rand and we sold out at 81 Rand, so we're not there anymore. Discovery has been our biggest position up to maybe the middle of this year when we had a full weight of 10%. So we actually bought in towards the end of 2009 at 27 Rand, 26.99. Beginning of this year it touched 41 Rand. And only recently it's gone up to 44 in the last couple of weeks. So the fantastic returns on Discovery you actually achieved in 2009, 2010, it hasn't really been that exciting. In the context of subdued overall market returns, Discovery recently has become attractive in the sense that it gave you a 10% return very quickly. So we continue to hold the 6% weight. We brought it down from 10. Old Mutual, we recently put a 4% position into Old Mutual. Again, that's based on conservative expectations. And on the long-short hedge fund which we manage, we actually have a modest Sanlam short position. So
you were following that insurance discussion closely.
Absolutely. Your previous commentator now, we both have actuarial backgrounds, so we both have insight and interest into the sector.